A high-energy video report on Strive Inc., ticker ASST, and its big pivot into a leveraged Bitcoin Treasury.
Right. It covers the 7,525 BTC holdings and the Semler Scientific merger. Let's dive right in.
Okay, so first off, the material is really good at capturing the excitement here.
Oh, absolutely. The writer has nailed all the key parts that make Strive, such a fascinating and volatile stock.
This core story of a company just completely morphing into a financial instrument, it's powerful.
It is. So our focus today is just making sure the analytical depth really matches the sheer complexity of the strategy they're using.
I agree. We're talking about some pretty sophisticated financial engineering.
For sure.
The material correctly flags that specialized financing, the Series A preferred stock, the SATA
exchange, which is pretty groundbreaking stuff.
It is, but here's the thing. The information is there, but if we're really aiming this at an expert audience, people actively tracking the stock, we have to go deeper than just naming the mechanisms.
Okay.
The presentation of the complex financial architecture, specifically that Series A preferred stock and the Section 351 exchange, it just needs deeper integration into the overall valuation analysis to fully satisfy an expert audience.
So what's the weakness, specifically?
Well, the material points out that the SATA issuance funded, 1,500 BTC at an average price of $103,000?
Which is a huge aggressive buy.
A massive transaction, but these powerful tools are explained briefly. And sort of, in isolation. The core implication, how using senior preferred stock really impacts the risk, the liability for the common ASST shareholder, is just stated as a goal.
So it says it protects shareholders, but doesn't show the math.
Exactly. It's not analytically verified.
Okay, before we get to the suggestion, can we clarify something? For listeners who might just follow the common stock, what's that seniority difference between ASST and SATA? Because that feels like the real crux of the risk here, isn't it?
It is absolutely crucial. When we talk about seniority, we mean who gets paid first if the company hits a rough patch or, worst case, bankruptcy. Common stock, ASST, is at the bottom. Preferred stock, SATA, is senior to that. It ranks above common.
So they get paid first.
They get paid first. They get their dividends, and they have to be paid back their principal before common shareholders see a single penny. This is why it avoids equity dilution, sure, but it introduces this massive debt-like liability.
Got it. So the material has to treat that capital raise not just as a pile of cash, but as a real liability that puts pressure on the balance sheet.
Precisely. The material should move beyond just saying how the money was raised and explore why this specific structure creates this unique leverage and liability that basically defines the entire investment case for AAST.
Okay, so what's the fix?
The suggestion is to reframe the whole Bitcoin buying strategy so it centers on that preferred stock financing mechanism.
Put the financing at the core of the story?
Right. This shift lets you explore the cost of that capital and how it really impacts the risk for common shares. You have to analyze that specific cost and put it right up against the company's current liquidity.
I think that's a fantastic way to bring the financial analysis to life. So how could someone actually implement that?
We need to use hard numbers. First, you take that $160 million raised via SATA and analyze the carrying costs. What are the dividend obligations?
Okay.
Then you juxtapose that liability directly against the $109 million in cash they have on hand. That tells a much richer story about liquidity management. It shows the audience that the cash isn't just, free cash, it's spoken for.
That's super actionable. And what about the other mechanism, the Section 351 exchange? The material needs to dig into the governance angle there, right?
Building on that, yes, for that Section 351 exchange, the tax-free angle, we have to analyze the potential long-term governance impact of bringing in these wealthy crypto whales as new equity holders.
It's a brilliant strategy to attract them.
It is, but it introduces a whole new class of powerful, potentially influential shareholders. Are these sophisticated players really going to be passive investors, or are they going to want a say in the company's future? That's a strategic risk the audience needs to get.
And finally, to really hammer this home, maybe dedicate a short segment comparing the risk and reward of buying ASST common stock versus the SATA preferred stock.
Exactly. Emphasize that seniority difference. Show the audience exactly where they sit in the capital stack. You're basically telling the sophisticated investor, look, here are two ways to play this trend, and here's the trade-off in risk for each.
Perfect. That really completes the picture on the financing side.
So we've established the leverage is baked into the capital structure. But what about the presentation of that leverage? Does a report structure do it justice?
That's a great transition. because the material does a great job hooking you with that high-impact data. 7,525 BTC valued at $673 million against an $830 million market cap. That grabs your attention instantly.
It really does.
But the counterpoints, that huge $192 million gap net loss and the cash burn, they're saved for a financial reality check section way later.
And we need to make sure the structure reflects the reality of the investment. So, to provide a truly robust and balanced critique, the structure of the material should foreground the massive financial leverage inherent in Strive's valuation. You have to integrate that reality check much, much earlier.
I hear you. The goal is balance. But couldn't the writer argue that putting the loss later builds suspense? You know, it keeps that breaking news energy going. If you lead with the bad news, don't you risk scaring people off?
That is the fundamental tension, I get it. But for a sophisticated audience, delaying critical financial risk, it actually undermines your credibility. The weakness here is that this separation reduces the weight of the potential bear case. You set this expectation of an extremely leveraged play, but then you delay talking about the immense risks that come with it. It makes that $192 million loss feel like a reluctant disclosure, like a disclaimer, not a core part of the thesis.
So the high-risk, high-reward nature needs to be the central theme, not just an afterthought.
Precisely. The suggestion is to integrate the key risks, the leverage, the financial losses, immediately after you present the Bitcoin holdings.
Right up front.
Right up front. This ensures a balanced, high-impact assessment that positions the listener to understand the extreme nature of the stock from the outset. If the common stock is basically a volatile call option on Bitcoin, you have to put that volatility front and center.
Okay, so you're saying the volatility and cash burn are the engine of this thesis. You introduce them at the same time as the asset value. How do you do that cleanly, right after mentioning the $673 million valuation?
Immediately after stating the $673 million in Bitcoin and the $830 million market cap, you pivot. You transition right to the immense sensitivity of the stock price to BTC movements. Frame the whole analysis as this volatile leveraged play where a tiny move in Bitcoin has a huge effect on the equity.
It's high-stakes poker.
Exactly, and the audience needs to know that. A concrete way to do this is to move the discussion of the $192 million gap net loss and the $109 million in cash right up to part 2. Directly contrast the balance sheet liquidity, the defense, with the sheer magnitude of the BTC asset value, the offense.
I think it would also be incredibly effective when you're talking about that aggressive buy of 1,500 BTC at $103,000,
Yeah?
to explicitly label that price point as a critical support level to watch. That grounds the idea of leverage in a specific actionable price target. If Bitcoin falls below their cost basis, that 103K mark becomes a very real source of stress for the balance sheet.
It makes the risk tangible, not just conceptual. And that leads us to the third big driver here, the pending merger with Semler Scientific.
Okay, so what I really like about this section is the quantitative clarity. It's crystal clear. The report correctly identifies the Semler acquisition as a critical catalyst based on adding over 5,000 BTC.
That number is powerful.
The combined company could hold over 12,525 BTC, which immediately puts them in the same league as much larger players.
No doubt, that raw number is powerful. But we have to ask, why this merger specifically? While the acquisition of Semler is correctly identified as a catalyst based on the BTC count, the material needs to expand the analysis to cover the strategic and qualitative implications of combining two very different corporate Bitcoin treasuries.
So what's missing?
The weakness is that it focuses almost entirely on the quantitative outcome, the BTC count, but it neglects the strategic why.
Right.
It doesn't explore how merging a company with legacy medical operations like Semler into Strive's new finance-focused structure affects things like management synergy, or a unified Bitcoin strategy, or even the strength of that whole anti-ESG narrative that's tied to figures like Vivek Ramaswamy.
So the merger is presented as just an accumulation play.
A simple accumulation play, not a strategic positioning move designed for market influence. The suggestion is to dedicate more focus to the corporate strategy behind the merger. Discuss how the combined entity will leverage its larger size to achieve its goals. Move the discussion from just counting BTC to corporate positioning.
We're moving beyond bigger equals more BTC
to bigger equals a better strategy and more market influence.
Exactly.
That scale changes the whole game, right? If they get past 12,500 BTC, they're in a totally different conversation about institutional adoption.
Precisely. We need actionable strategic insight that explores that shift. For example, analyze how the combined entity's huge BTC holdings, that 12,525 plus count, bolsters the narrative comparison to MicroStrategy. What does that scale do for institutional credibility? Does it make it easier for them to raise more capital down the line?
That's critical. And since Semler had those legacy medical assets, we can't just ignore them. That's a really important strategic nuance. We should explore if those assets will be used for future capital raises.
You mean to provide a non-Bitcoin-related financial ballast?
Exactly. If they need to raise cash without selling BTC, does that diversified revenue stream give them a strategic advantage? That's a key question for a company this leveraged.
That's an excellent point about diversifying capital sources. A Bitcoin treasury that still has a small, revenue-generating legacy business might be structurally superior to one that's completely dependent on its crypto holdings. It hedges the risk a bit.
And finally, let's tie this all together. Since we critiqued the Section 351 strategy earlier, we should connect the merger back to that.
Absolutely. As a final powerful example, connect the merger to the Section 351 exchange strategy. Suggest that the newly available shares from the merged company might be used to target specific large Bitcoin holders for that tax-free swap.
Including current Semler shareholders, maybe?
Potentially, that shows the corporate maneuver is designed to hit multiple goals at once: accumulation, narrative, and optimized financing.
This has been a really deep and comprehensive look at Strive's pivot. So, to quickly summarize the three main takeaways for improvement.
Go for it.
First, you have to deepen the analysis of the SATA preferred stock and the Section 351 mechanisms. Don't just name the tools, explain the risk and governance implications for the common shareholder.
Second, the content needs to be restructured. You need to foreground the extreme financial leverage and risk immediately after the asset valuation. Present a balanced assessment right from the start. Don't save the bear case for the end.
And third, expand the discussion of the Semler merger beyond just the raw BTC count. Focus on the strategy, the corporate positioning, the management synergy, and how those legacy assets might play into future stability.
These changes will take what's already a strong, high-energy report and turn it into a truly robust investment-grade analysis that will satisfy the most sophisticated audience.
I agree.
We genuinely believe these changes will significantly increase the material's impact. So take these suggestions, implement that deeper analysis and strategic framing, and we absolutely invite you to send the updated material back in for more feedback.